Welcome to Advisors on Growth. I'm your host, Derek Collin. Today, I have a special guest for this episode. His name is Jonathan Miller. He is the owner of RoBus Mortgage. How you doing today, Jonathan?
Good, Derek. Good. Looking forward to it.
Awesome, awesome. Well, hopefully we didn't get off to a rough start, but today is the day, and I wanted to kind of dive in. Can you share a bit about your background, your role, and how it fits into the bigger picture over at RoBus?
Yeah, sure. So I was walking down a hot industrial park in San Diego back in 2001, trying to sell Xerox copiers, printers, scanners, fax machines outside B2B sales, getting doors slammed in my face. And I said, there's got to be an easier sales job out there. So I saw the loan officer at the bank when I went to the bank, just sitting there kicking back in the nice air conditioned, waiting for clients to come to him. And I said, you know what? I need to try that out. So here I am 25 years later, still in the mortgage game. Started at a bank, went to a brokerage, 2008 hit, went to work for a big direct lender. And then I started this company about 9 years ago. And this company, basically, I took all the things I'd learned in 16 years prior to that of being in the industry and said, okay, these are the things I want to do to make this the best experience possible for my clients and for my employees as well. So I love what I do. This is the best thing ever.
Awesome. That's really cool. So what major shifts are you like seeing in your industry right now?
So, I mean, a big shift is going to be AI, obviously, for all of us, all
Mm,
the white collar workers out there in roles that can be automated. So, in our world, AI is probably going to take over a lot of the A paper clients that have cookie cutter scenarios, say 20% down, 740 credit, W 2 income that they can quickly verify. A lot of those, I think, those clients are going to go to AI in the future. But the when I started this company, my biggest niche is focusing on the tougher deals. Our biggest niche is self-employed clients because they always have different scenarios, different income scenarios, different assets that we can deploy. And so AI, it's going to be a long time before AI will start doing those more complicated loans that require a lot of creativity, interaction, and outside the box stuff that's not going to fit neatly into any type of AI scenario. That's what I'm excited. I think we have a business model that will last based off of that and a number of other things.
cool, cool. Yeah, there's certain nuances and intricate things that humans need to do from an emotional level, from an experience standpoint that AI may not have that experience yet to autonomously really critical thinking and creative thinking the way we do. And there's certain little you got to dot the i's and cross the t's and things that it misses, that it's just not quite there yet. So how has this trend when it comes to AI impacted your business or growth strategy? Has it been negative? Has it been good?
I mean, so far it hasn't really helped me. So, for example, one of our biggest investors uses AI to reach out to all my past clients, and I have yet to convert any of those. It calls them, it texts them. None of those have resulted in any new business for me at this point, and that's been going on for well over a year now. WM, they have a thing called Mia that reaches out to all my past clients. It's not very effective. I have been, look, at some point I do need to probably set up some type of AI voice, call, text campaign. But the only thing I can see where that would help is with aged leads or old leads or cheap leads where you're just trying to establish a first contact with them and anything to
Indeed.
get them on the phone or get them to respond. And AI can just sit there and go through thousands of those and hopefully generate one deal out of thousands,
Yeah.
potentially. I could see AI, being maybe decent just for client retention, just to maybe touch points with clients. But I've already got drip campaigns set up with them via email or via text that I can do myself that doesn't need to involve AI. I don't know. I mean, to be quite frank with you, I know one of our big lenders we work with, SunWest, they use a lot of AI called Angel AI, and that's their niche, that's their thing. They're trying to become the wholesale lender in the broker space or in the correspondent lending space, which we're also in. There's a lot of AI to save on money, but at the end of the day, you need to talk to a human a lot of times, and they
Yeah,
have
yeah.
human reps that we deal with. They have to help shepherd the file through because AI can only get you so far, like you were saying earlier.
Yeah.
You know, when I on my Icon pass for ski resorts the other day, I had kind of a tricky issue that the AI prompt thing couldn't resolve. I just had to keep asking for customer service representative, you know?
Yeah. So I know that it works good in terms of, I think you spoke about this, but like where the AI will text message missed calls or missed opportunities and call people back and scheduling and stuff like that. And it's probably a good use case for maybe like electricians when they have contracts and they don't want to miss out on an opportunity, or maybe restaurants when someone needs to RSVP or reserve a spot or bottle service or something like that. And they don't want to miss out, on an opportunity when someone calls in to make a reservation or to book a contractor or an electrician, right? Maybe the HVAC world or something. But it has its use case. But in some cases, I've never heard of Mia before, but that sounds interesting. So
That's their just what they brand their AI that their proprietary AI where they probably programmed it in along with the CRM, like Go High Level is a very common one that we use in our industry, or maybe even Salesforce. I don't know what they used along with it, but
yeah, and I noticed on your website you had like a full team. It looks like there's a lot of you guys that are working within your organization, different titles and so forth. So when an issue arises, when do they typically bring you into the equation? Is it HR, talent acquisition, when you're onboarding someone new? How does that work?
well, so we're a very small company. I essentially, the staff that you see on the About Us on the RoBus
Yeah,
Mortgage website is mostly loan officers that are 100% commissioned. I've got one loan processor. He basically helps on the back end on the operational side whenever we bring in a deal. We take the application, collect some of the docs, sell the deal, ideally lock it in the rate so that the terms and the rate are set so that that's not
yeah,
going to change, and then kick it over to him, and then he helps shepherd the deal through from application to closing. So that the processor is integral for that. And then my other assistant, she basically does everything for me. She funds our loans because we fund about 2/3 of our own loans on warehouse lines of credit with several investors. So she's my funder. She's also does my bookkeeping, my payroll, my state audits. We're being audited by the state of Washington for the third time, which is always fun. But that's why make sure we're on top of all the latest regulations and all that.
oh,
So she does all that for me, and then the rest are all sales. So I'm getting calls all day, every day for various things. The biggest challenge, quite frankly, is onboarding and training new people. I haven't hired somebody new in a while, just because it takes a lot of time. It takes time and effort, and I can only hire people with experience because they have experience in the industry. But I still got to train them on our systems and our way of doing business and how we price loans, et cetera. So every company is unique in that regard.
yeah, yeah, definitely. Can you describe to the audience, your primary like industry, like what it is that you do, as a mortgage broker for Robust
Yeah.
Mortgage? What's working well for you right now and what's been frustrating?
Yeah. So what's working for me now are HELOCs that we're doing for self-employed clients or investment properties. We do 5 day. They average about 5 business days from application to clear to close, typically. We've been doing a ton of those. That's really well. There's a lot of demand in the market for
Yeah.
those. A lot of people that got those low rates in 2020, 2021, but they need money. They need to tap into their equity for a million reasons, whether it's paying off debt or growing their business or whatever. Divorce could be one of those reasons. Who knows, right?
Yeah.
So anyway, so we've been doing a lot of those. That's been working really well. We also do a lot of loans for self-employed people, first lien mortgages where they're buying a house or they're doing a full cash out refinance. And so we use typically the usual solution for that is just 12 months of bank statements, average their deposits. That's the income. But we can also do asset depletion. I'm doing a loan for a guy that's got 2 million in various brokerage accounts. We can essentially take, okay, 2 million, we can divide that by 60 months. That's 5 years. And we take that monthly amount, and that's the income that we give him. The
Mm.
guy's in between companies. He sold a business. He's starting a new one. So his bank statements aren't that great, but he's got the assets we can use. So that's a
Yeah.
work on. We also do what's called a no ratio loan in our industry, where we do no income at all, but they got to have 15 months reserves of a full mortgage payment plus decent credit. And they got to have money to put down at least 20% down on a purchase or 25% equity on a refi, et cetera. So we do those too, but we do a lot, and we do rental income loans. They call them DSCR in our industry, debt service coverage
DSCR.
rate, DSCR. Yep.
Okay.
Debt service coverage ratio. It's like a commercial loan on a building where you're using the rental income, the net operating income of that building to qualify the loan, to say, okay, is this debt going to be serviced by the income that the building brings in? Take that all the way down to a granular scale to a rental property. Is the mortgage 2000? Is the rent 2000? Okay, we're at a 1-to-1 ratio, 1.0 ratio. Go below that, let's say the mortgage is 2200, but the rent's 2000. Now you're like at a point 0.8 or 0.85 ratio. So it's going to be a
Yeah.
lot more expensive. They got to attach a risk premium. They got to put more money down. They got to have better credit to qualify if the ratios are below 1.0 on a DSCR loan. So we do a lot of those. It's a business purpose loan. You don't need licensing in about 39, 38 states to do those loans.
Yeah.
So we do, that's great for real estate investors or people buy. That only works for investment properties, right? You're using rental
Yeah.
income.
Yeah, yeah. And is there a certain amount of units? Is there a certain amount of the loan for the? Go ahead.
I mean,
Sorry. Yeah.
typical, the minimum loan amount's 100,000 across the board, but we've gone as low as 40,000 on these. We just did a HELOC for 25,000, but usually most lenders are 100, 125,000 minimum. With the DSCR loans, debt service coverage ratio loans, common acronym we use in the mortgage industry for those in the non-QM space, non-qualified mortgage, basically stands for anything that's not Fannie Mae, Freddie Mac conventional, or Ginnie Mae, which is FHA, VA, USDL, your government loans. So
Yeah.
anything that kind of fits outside the box, basically any loan where you're not using taxable income, net taxable income after all write-offs, qualify with those government sponsored enterprises that are supported by taxpayer dollars, right? So they need taxable income to qualify. It falls into this non-QM world, which is bank statements, asset depletion, DSCR. DSCR is great because it's like a commercial loan. You don't need licensing in a lot of states. We can go up to 30 units with a lot of our several lenders on those. Some of them only go to 8 units. Some of them only go to 4 units. 4 units is the standard cutoff where it becomes commercial versus residential. So if you're 5 units, you're commercial. 4 units, you can go fourplex, residential, Fannie Mae. Put 5% down if you're going to live in one of the units, right? It's a great way to get into a fourplex, or 3.5% down on FHA. And buy one and say you're going to live in one, right? So anyway, yes, CR loans are great. You just go off the rental income. It's a 1-to-1 ratio is what they look at. So if it's $2,000 for the mortgage with taxes, insurance, everything included, $2,000 for the rent, that's a 1.0 ratio, 1-to-1. If the mortgage payment is higher than the rent, let's say your rent's at $2,000, but your mortgage payment's at say $2,500 a month, then you're at like a 0.8 ratio because you're 0.8% or 80% of your rental income. Your rental income is 80% of your total payment. So 0.8. So then you're a lot more expensive. Anyway, bottom line is we do a lot of those. It's a great product for real estate investors where they may not show a lot of taxable income because they write up a lot of it on with their rentals or whatever they're using, or their capital gains they're getting from flipping properties. So it's a great product for them. A lot of real estate investors love those. In fact, I just got off the phone with a PIC. It's like a private investment company where they're buying tons of properties. They're trying to set up 15 different brokers to help them do DSCR loans to buy all these single family residentials that they're buying in Florida and places, or Texas, for 100 grand a pop, 200 grand a pop out there right now.
And they're
So
using the funding to fix them up or buy furniture or rent it out.
had them just to fix them up a little bit and rent them out, essentially.
Very
So
cool. Very cool.
long-term
Awesome.
fun.
Yeah, I guess what do you want people to know about RoBus? People, real estate investors that may want to work with your company, your organization to get funding.
Yeah, I mean, the most important thing I would say is if you're self-employed, call RoBus Mortgage because we're going to give you the best deal out there, better than any other place. This is what we've specialized in for a long time now. There's a lot of great options out there. You'll find a lot of times the rates and the costs are not that much more than a conventional loan, especially if you have decent credit and you're putting down a decent down payment. On a bank statement loan, you want to put at least 15% down to get good pricing, but 10% is usually the minimum. So you need a little bit more down than a conventional loan. But as long as you've got that and you got 12 months of bank statements that show a decent income, you're going to qualify for a good loan with
Yeah.
rates typically in the 6% range, which is great right now in the market we're in. So I would just say, hey, if you're self-employed, call us. We can do home equity line of credit, second liens. If you already own the property, you need to tap into your equity on your rental or your primary or your second home. We can do those in 5 days. If you need to buy a house or do a cash out first lien mortgage, we're great for doing those too. We have a lot of options. We can tap into your assets, or we can use rental income to qualify. If you're a real estate investor, we can use short-term rental income to qualify. So the property can be vacant. You can use these DSCR loans to buy a property that doesn't have a tenant in there. Maybe it needs a little bit of fixing up. As long as it's in habitable, livable conditions, so no holes in the wall, no exposed subflooring, no holes in the roof, as long as it's in livable condition, do a loan, we can get there's hundreds and hundreds of institutions out there that will buy these things. They package them up and put them into mortgage-backed securities, just like they do with Fannie Mae and Freddie Mac. But they're doing it with hedge funds and life insurance companies and other big institutional investors that are buying these, and they're servicing the debt. If you're not putting as much down or don't have as much credit, maybe rates in the 7 or 8% or even 9% range. So there's always probability and statistics. There's a risk assessment that goes into the profiles on all these things. And so they're
Yeah.
getting the return that they need to offset any risk. It's very manageable. It's not like the subprime loans that I was doing back in the 2000s, where
Oh
you
yeah.
were a stripper from Las Vegas with no money in the bank,
Yeah.
no credit, and we still gave you 100% financing to buy a house on the 82.
Subprime.
Yeah, no wonder
Yeah.
why we did 2008, right? I mean, it was
Yeah.
ridiculous.
Yeah.
The That's all gone away now. You got to have a lot of offsets in the form of assets or credit or experience in order to qualify for these loans that can't be sold to the big GSEs, the government sponsored enterprises such as Fannie Mae, Freddie Mac, Ginnie Mae.
Yeah. Yeah. Yeah, that's crazy how they created that subprime. It's like, man, that really screwed up.
And then they packaged them in with prime loans, and then nobody knew the difference. They hit them. They threw them in and created all these crazy tranches of debt. I mean, Wall Street really
Yeah.
kind of fumbled that one. But I mean, of course, I was on the front lines. I was the guy selling the option arm where you could have negative amortization, where it would literally accrue interest on the back end of your loan and you'd lose equity over
Mm.
time. I mean, wonder why those were going underwater.
Yeah, that's crazy. The Big Short. So
Yeah.
yeah, so where do you see Robust in the next, 6 to 12 months from now? How's business?
I mean, business is great. For the first time in 4 years, well, we turned a profit last year. We had 3 years where we didn't turn a profit. It was brutal. From 2022 to 2024, we lost two-thirds of our industry because
Hmm.
rates went up significantly, almost triple. And so you lose all your refinances unless somebody's getting divorced or they need cash out or whatever. And then a lot of times they're just getting an equity loan. They don't even need a first lien from us. So really all you have is purchase business, but purchase business has slowed down because a lot of these people that are in these low rates aren't selling their house. They don't want to go from a 2.5% mortgage to a 7% mortgage because
Yeah.
so they're only selling if they have to. So you don't have a lot of and that's still a problem today, 4 years later. This is actually the most inventory we've had on the market in 4 years right now. But now you have an issue where it's a seller's market. You don't have as many buyers because the economy is so up and down with inflation and the war and everything that's going on right now.
Yeah.
And you have a full seller's market. So it's a great time to buy if you can justify it, if you can afford it. Look at your rent that you're paying or look at your current mortgage if you need to upgrade and see what it is. And if you can afford it, great time to buy. You're going to get some great deals out there. I was just looking at condos in Vegas for under 100K right now. You wouldn't have found those a year or two ago. They would have been 200K or 300K even 3 years ago.
Yeah.
So yeah,
Yeah.
business
That's
is
crazy.
good. We're on the upswing. The war is not helping, but with refinancing, because rates are going back up again, inflation is the enemy of long-term fixed income securities like bonds and mortgage-backed securities. So whenever you have inflation, rates are going to go up. That's not good. But that being said, they're still not as high as they were 2, 3 years ago. We're still in the 6% range. We were up in the sevens a few different times. So we're not quite
Mhm.
there yet. So hopefully it'll stabilize. They open the Strait of Hormuz and we can get back to doing some business because we were on a great trajectory in February right before the war hit. We were getting
Yeah.
down in the 5% range, and it was going to open up a lot of opportunities for refinancing for a lot of people, but the war quickly changed that. And so hopefully they can get that resolved.
Yeah, definitely want to see that resolved, and peace through strength and all that good stuff.
Right.
um,
Sure. Yeah.
so yeah, Jonathan Miller, ladies and gentlemen, owner of RoBus Mortgage. Thank you so much for joining us on the Advisors on Growth podcast. It's been a pleasure. If you guys want to check out his website, you can go to robustmortgage.com. That's robustmortgage.com. Thank you so much,
No
John.
T, no T on the end. It. Latin root word for strength. Robust with no T.
Oh, that's cool. Yeah, I didn't know that. So that's the definition.
Yeah, it's the Latin root word for strength or stronghold. It's so I was just trying to pick something unique where, it's not just American home loans, right? There's a million of those out there. So a unique name and URL, kind of like Yahoo or Google or whatever,
Yeah,
So
definitely. Awesome. Well, there you go. Robustmortgage.com. Thank you so much for joining us, Mr. Miller.
okay.
It's been a pleasure.
Thank you, Derek. All right, man. Have a good one. Okay, sir.